Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about where rates are going after Fed Day and where we are on housing inventory and home prices. A lot to talk about. Logan, welcome back to the podcast on Fed Day.
On Fed Day, and you and I are both in Nashville right now, where we'll be speaking. Yeah, we'll be speaking actually when this podcast comes out tomorrow.
Okay, well, it's not we. You will be speaking. You're one of their keynote speakers.
I know, but you're part of the team. So I'm always going to say we. You have this problem when I say we, and you want me to say I, and you're talking to a old high school basketball coach here. So
no,
come
it's
on.
just, I'm sure people are like, well, like it's going to be a team sport up there. No, it's just you up there. I'm doing podcasting and interviewing and stuff, but yeah, it's exciting. Okay, so what's happening on Fed Day?
Okay, so of course, Fed didn't raise rates or cut rates. And I think a lot of people were thinking maybe Powell goes a little bit more hawkish than normal. And he kind of even keel, to me, was slightly more dovish than what was anticipated. Now, of course, for months now, we've been talking about that the Fed's going to slow down its tapering process or it's winding down of the balance sheets. And they announced from 60 billion to 25 billion, 30 billion was kind of the estimate. So maybe some people might have taken that as slightly more dovish. But I think the Q&As were interesting. Powell was really adamant, kind of like not wanting to talk about another rate hike. And the ECI wage index, which is one of the Fed's main wage indicators, actually was stronger than what was anticipated. A lot of that from union wages catching up from the past. And he really didn't kind of talk about that until the end, where he says he doesn't want to target wage growth, but the Fed has this wage model and productivity model. Productivity data was unbelievably awesome this week. In normal senses, the Fed wouldn't have a problem. I just don't believe the Fed believes the productivity number is real. So he wanted to make sure that we're not really targeting wage growth, but they are. The labor market was a big part of today's discussion, which, of course, for you and I, since the end of 2020, it's all about the labor market. And he basically said, okay, if the labor market starts to break, yeah, we'll cut rates. So I think finally there's more of a recognition on that if jobless claims start to break, like we said, they'll pivot, right? And he basically outlined it, what a pivot could be. But he also kind of said, we believe that the growth rate of inflation will slow more toward the second half of the year. And like always, everyone cites the rent data. So I think overall it was fine, considering all the factors. The 2-year yield was very wild today. 10-year yield, not as crazy as one would imagine, but it actually laid the groundwork for if the growth rate of inflation does slow down a little bit more, then you could have maybe one rate cut toward the end of the year. Or if the labor market starts to break, and I always try to make sure people realize that if the labor market is breaking, the 10-year yield's going lower. Mortgage rates are going lower. They're not going to wait for the Fed. Okay, so the labor data today, job openings, Sarah, job openings, our favorite. He actually talked about how the quits ratio is kind of pre-COVID, and the hires. A lot of things are kind of back to normal in that sense, and they really highlight the job openings data for many years, and I think that was good to see that there are a lot of labor dynamics and they're slowing down. They're not breaking, but they're slowing down. And that's an important thing to think about for the rest of this year, that if you actually saw more authentic weakness in the labor data, meaning jobless claims start to rise with some little bit of a kick into it, the Fed has outlined what they would do. That would be, to me, what a pivot would be. And he laid the groundworks for that.
So he laid the groundwork, but, any hope of something happening, say, in June is probably just not going to happen, right? That doesn't give us enough time.
Again, it all depends on, to me, the weekly labor data is the key. I mean, all of us could have a different takes on where the Fed is going, but if the economic data got weaker, and like we said, labor data is outperforming. When we do these job reports when we write those article ups, we outlined our labor model. It's our model, Sarah. Okay, so you're gonna have to be part of this team. In this case, the labor market is still beating estimates, and I take all the revisions of all the job data and everything. It's still beating, and jobless claims are still low. But if that starts to go away, the bond market has showed us twice now at the end of 2022 and end of 2023, they will take yields lower before any Fed rate cut. So that's not the issue. But the labor data and Powell really talked about some of the unique dynamics that listen. The growth rate of inflation fell a lot faster than we thought last year, with the labor data being really good and wages still being higher than pre-COVID. So I think he wants people to kind of, let's not, we're not going to start hiking rates because more jobs are being created. I thought that was a good thing on his part, trying to, people are trying to like egg him on to say rate hike, and he didn't fall for the bait.
So interesting. There's so many things going. You and I talked earlier about the fact that construction jobs, they're one of the keys to this labor market breaking, right? And that we have seen that whole slowdown with the apartment boom is over. So what about that?
It's interesting. The job openings for construction labor fell noticeably, like a violent crash. Now, this data line is very noisy. You'll have some violent crashes and nothing too dramatic happens, but we've always highlighted the permits for the apartments are now at COVID-19 recession levels. If it goes on trend, we'll be at the Great Recession levels. We're starting to see the format of actually, we're not going to have the production in apartments going out in the future because they just can't start up like that. So if permits keep on falling down for another year, it's going to eventually bite us down 2-3 years down the line. And business investment in that sense, it's not shocking that people are not issuing permits, or even some cases, the apartments that haven't even started or finished construction, they're just calling it quits at this point. Again, it has to make money, it makes sense, and rates are too high. So it's just one job openings construction data, but it was a noticeable one. So we'll see how that goes out, because we now actually have authentic data to run with this. It's not like permits are rising for both apartments and single family, like what you traditionally see in every economic expansion post World War II. We have a clear deviation. And if single family permits start to fall, rates go high, you've got an issue there as well. There's only so much the builders can do in terms of paying down rates. But in this case, it's something to think about, because like we've always stressed, why housing leads you in recession, higher rates. It's housing first on the construction side. Those people get laid off, then the recession happens. That's how it looks. So much weighted on the inverted yield curve, but inverted yield curve needs construction workers, residential construction workers, to lose their jobs. And by now we're in May of 2024. We can see that the recession of 2022 and 2023 didn't happen. That's the one data line that it was really lacking, which was the fifth recession red flag that we raised and then took it back down right after November 9th.
You're very careful about when you say this is a recession. You have all these signs you want to see, and you never want to get ahead of that. You never say the R word unless you're sure.
Well, the thing is that society rewards doomers, right? If you just constantly spat doom all the day, you get a lot of attention. I always thought that I was raised a different way, so I don't understand like being wrong for so many years and just like thinking you're an expert. But I mean, people were just raised different. That's how I see it. I think it's a cultural difference about, bashing the country that you live in and then being wrong all the time. And you could look yourself in the mirror and think, boy, I have a great life. In any case, the sixth recession red flag, which remember, we took this to the conference board. It's a progression model. It's designed to be early. And then once all six flags are up, we're supposed to look to see when jobless claims breaks, right? You don't have a recession to jobless claims break. And well, what happened is everybody went doom porn in 2022 and 2023. And I could understand 2022. I get why some people did that. But when some of the things change on their models and you don't go with it, then what are you? You're a one-trick pony. And one-trick ponies to me are like men who grow up in cults and don't realize they're part of a cult. And then the very last day they live on planet Earth, they go, God, I was part of a cult. I wasted my life. You don't want to be that guy. You don't want to be that guy.
No, you don't. Okay, well, let's talk about the tracker. Let's talk about, well, are you done talking about the Fed day?
Yeah, Fed. I think there was, to me, it was pleasantly, surprisingly good today, considering everything we dealt with, and not a lot of fireworks were anticipated, potential fireworks, and he did a good job there. If we're going to talk about the tracker, we are 2 for 2 now, right? In terms of inventory growth with rates above 7.25. And I think it's somewhat, I hope people can understand why being part of team higher rates in 2021 and 2022. Because look, this week, home prices, boy, 6%, Case-Shiller's, Freddie Mac, FHFA, year over year. Just remember that early in the year, rates had gone lower. The price cut percentages on our weekly data were actually heading below 2023 levels. It wasn't the case now because rates had gone up. So Case-Shiller, a lot of these data lines lag the current data. But again, the velocity of housing is just not like it was in 2022. And I think that's just the thing. It's interesting. There was such a shock and awe that they're like looking at the data and they're like, oh my God, it's up 6% year over year. What's going on? It's this like, guys, there's a supply and demand equilibrium. And the 2020 housing market was very unique. We did have authentic price declines in the second half. That doesn't happen actually quite often going back to 1942, but it did occur, and then home sales stopped crashing. And I encourage everybody, go back to November of 2022, look at the existing home sales market. We went from 6.5 million to 4 billion. We took 3 years of a crash sales data and put it into 12 months. So now it's just bouncing off these levels, and the supply and demand equilibrium is much more difficult to know how to read it unless you have live weekly tracker data like we do, right? And I think by now, hopefully, our work has justified itself, and the year 13 of the housing crash. What was it? Sexless men video games this year? That's the thing? Yeah.
I think that's what you said, yes.
No, that's what Meredith Whitney says. Yeah. So hopefully by now, the price growth is cooling, the price cut percentage is increasing, but the supply and demand equilibrium, it's a little bit different than 2022. So we take it every single week. We can let everyone know so you guys have an idea. So we don't do this again. Like literally, there were people shocked because nobody can believe. Like the Freddie Mac index was up over 6%, and everyone's like, "This is what's going on." And I said, "Guys, follow the weekly data, follow forward-looking data. You'll see it. Price growth is cooling, but the slope of the curve, right? We always highlight the slope of the curve is not like 2022. So we'll do it every single week. We'll keep everyone informed, and just know that the price growth is cooling down as rates go up, inventory is picked up. But you got to realize I'm 2 for 2. Only this is it, right?
And that's
this
2
is the
weeks.
last.
That's 2 weeks.
The last 2 weeks. I mean, I was batting a whopping 0 in 2023. And if you track the weeklies in 2023, you could realize, wow, how home prices finished up near 6% for the year. Here, we're seeing finally some growth, finally some kick in the data, but it's just this last 2 weeks now. You're going to need a lot more to really change the dynamics in a bigger fashion, like we saw in 2022. And I encourage everyone, if you see our charts on the weekly tracker, go back to 2022 and you could, holy dear man, that slope of the curve is very fast. And that happened with the biggest and fastest crash in home sales ever in history. So you don't be shocked that home prices were up 6%. Just know that things are cooling down already as the weekly data has changed. This is why we always say more data, less vibes. And you don't want to be the person that says, I didn't see it coming. We're here for you, right? New listings, active listings, price cut percent. Can we have all this live weekly data and you could be informed so you don't have to wait for the case? It's funny. It's like back in 2023. Remember we did that podcast in June and everybody completely lost it because home prices were back at all-time highs and people go, no, wait a second. How did this happen? I'm like, it's November 9th. Here we go. Take the weekly forward-looking data and go with it.
I think the thing is, so a couple of things. When you said you were batting 0 last year and you've gotten to what you wanted to see was inventory growth of between 11,000 homes and 17,000 homes per week for multiple weeks. And so for the last 2 weeks, I think 2 weeks ago we had around 16,000, and then last week we had, was it 13,000? Around 13,000?
Yeah. And the model is based on rates getting above 7.25. Right. So last year when we were heading toward 8% and I was batting a zero, I'm like, God, man, this is harder than I thought it would be. And then just remember that new listings data last year was trending at the lowest levels ever recorded in the history of America. And I always like to highlight to people, we're running between 30 to 90,000 a week per week from 2021 to 2024. If you want to see what stress data looked like, it was 2008 to 2012. We're running at 250,000 to 400,000 per week. So it's funny, Sarah. Yeah, a week. So it's funny because you see these people with their trolling things on new home inventory. Just remember that we have 89,000 new homes available for sale. We had almost 3 times that amount easily every single week in active listings because inventory really comes from the existing home sales market. Every single week for 4 years is more than what we have in the total nation of the United States of America now with new homes available for sale. So just remember the active existing inventory is where all the real inventory growth is. And even now, we're going to be probably getting to 90,000 at some point this week. So at 1 week, this year, we're going to have new listings data just for 1 week override the entire new home sales sector. So always put less weight on the new home sales sector in terms of the amount of supply available units for sale, right? It's 89,000. And it really goes into like, a lot of people see the 8.3 months of supply. We have an abnormal high months of supply in terms of those that are under construction or haven't even started yet.
Also, because we had because we've trended better all year, but especially the last 2 weeks, you think that what you said last week was like this week we might see inventory get as high as it did all of last year. Like we might already be there.
We're heading. As long as everything stays the same, we'll get there definitely this year. But what we haven't seen is, to me, an explosion of active inventory yet, to where we saw, let's say 27 to 41,000, something like that. We haven't had one of those weeks. So 11 to 17,000 would be like normal. Like that's like a normal inventory growth with higher rates, right? That's how I always think of it. Higher rates, more inventory can grow. We had that last year when rates were getting to 8%, but I think near 10,000 was one of the weeks. So we just didn't see the growth rate this is myself. This is no one else. It's not even Mike Simonson or anybody else. This is just my model. So the last 2 weeks were the first time that we actually saw this.
That's good news because, I mean, one of the things that it's been a pretty tough housing market and inventory has definitely been one of those things. We did a story that we just published today, or this is on Wednesday, that talked about the fact, though, that the inventory, you have to kind of look at it because some of the inventory is coming from 2 places, Texas and Florida, right? Disproportionately are having more inventory. How do you think that affects the overall national numbers?
Well, I mean, to me, the real story in Florida is the condo market has got some issues, got some structural issues that the general marketplaces around America doesn't have. So you want to keep an eye on Florida for a avenue, what we call stressed inventory, especially fixed income housing, elderly homeowners. All of a sudden, their homeowners insurance go up, and then you don't know when that's going to stop. So that's different issues. Now, in general, Texas and Florida are always big anyway, just because they're 2 very big population states. But I would say this is a little bit different just because of the insurance issues in Florida. Texas, of course, have property taxes and insurance issues. But to me, Florida is kind of like that condo market is very unique in that sense. And then everywhere around the country, it's just, it's growing. It's not much really going on a big scale difference. But since I'm a very pro-supply person, I just want to see 2019 inventory levels. Then think about it. Then I'm never going to say the word low inventory ever again. I was not a low inventory person in the previous decade. I was like making fun of those people. I said, there's plenty of homes to buy. Look, the days on market are high, everything. But that changed post-20. So I got to change with the data. And I just think a lot of people didn't want to change. I mean, we still have some crazy people out there that say there's no housing shortage whatsoever. Like active listings being at all-time lows is not a real thing. And these like the people who think like, nobody landed on the moon or stuff like that. So, I mean, it's just read the data out there. So I'm actually more happy about the housing market this year than last year. Last year, we had record low levels of sales, new listings data is trending at the lowest levels. Inventory didn't really go. It's not a functioning marketplace. But this year, pending contracts, the year-over-year demand is actually growing a little bit. Nothing great, but it's still growing. New listings are up, inventory is growing. So this is like so much better than last year, and as close as I could get to like maybe looking somewhat like a normal housing market and how it would operate. Again, this is all with record low sales and very high interest rates and relative to what we had, before the Fed actually pivoted to take rates up higher.
Okay, so I'm wondering if you've just called down on our heads all of the people who believe in the moon landing conspiracy. So we'll let our audience know who we hear from that is like, what are you talking about, the moon landing? Okay, so we'll see how that goes. You never know, Logan. People believe a lot of things.
Oh yeah. Oh, trust me, I know, Sarah.
You do know. You know.
Trust me, I know. If I could show you the private messages I've gotten over the last 15 years, there are some. You know what it is. There's just guys who need a hobby, like a real hobby, like just like something productive.
You think it's mostly men, huh?
It's guys. I always told you I never have to worry about women. Women are fine. Even the crazy anti-central bank women are normal compared to the guys. The guys are just like completely gone, and it doesn't get better when you get older. No. Wheeler, it does not get better for these guys. This is why they hate my hair so much.
They do hate your hair. They take it personally.
They took it personally.
You grow that hair. Okay, so one thing I wanted to point out, because every time you say, that we had the sales crash in 2022, the biggest sales crash, from that height down. One of the things about that, every time you say that, is like, it wasn't a home price crash, which is one of the things I think that people were really confused about. And the reason that, people are still like, they can't believe that home prices grew 6%, right? According to these things.
It's interesting you bring that up, because on Twitter today, or X, I showcased how the first few months of 2022 looked like, and it was really hot hype. Remember, I threw in the towel on the housing market in February 2020. I said, screw this. We need to break this thing. This is getting ridiculous, because home price growth was so hot the first few months. And then as rates started to rise, we actually saw authentic price declines, like not the seasonal weakness that we see in the second half, but we actually saw price declines. It just wasn't enough to offset the first few months. And that's why total annual gains were like 5.7% in 2022, which was like literally the forecast for 2020. See, this is where the forecast was 100% right, but it's for the wrong reason. See, this is why I always say that my 2022 price forecast was wrong, in the sense that even though it got to the exact number, home prices accelerated out of control, and rates didn't get high enough, fast enough to cool down the growth rate to take that off. So it's just because the first few months were too hot. So in this regard, we literally had the biggest sales crash, but we authentically had price declines, even though inventory was near all-time lows, even though a monthly supply was near all-time lows. The homes that were in the market, the supply in there needed to cut prices, right, to move. And there was enough of them to create that downward pressure in prices. This is why I tell everyone, don't put all your eggs basket on the low inventory without realizing, let's do a hypothetical. Let's say home sales went from 4.1 million down to 2.1 million. And in 12 months, we have seen that this can actually create prices to decline. So a low inventory can prevent big national crisis, but in a short period of time where people have to sell their homes, when demand falls that fast, you see the price cuts kick up. And that's what we saw in the data, in the weekly, the tracker data. You can just see the price cut percentages really went up, the active inventory went up, and low inventory couldn't block it. What low inventory does is, when housing sales stabilize, changes everything, right? That was the whole November 9th thing. So there was a good discussion about that today on social media.
So to recap, we're still in the higher rates for longer. No change there from today's Fed meeting. We got more inventory, which we're excited about, but it's not yet affecting home prices, where you're going to see, home prices come down.
The growth of home prices are cooling. At current rate, I was going to be wrong this year because my forecast was too low early on. So the growth rate is now cooling enough. There was a chance for me to be right. So we'll see how the rest of the year goes. And again, it depends about rates. My God, rates just getting down to like 6.75, something like that, changed the dynamics again, right? And we could see it in the early home price index. So it's just one of those things. We have more sellers this year, but those sellers tend to be buyers. So the pending contracts are actually showing year-over-year growth. It's one of these things you really have to track live weekly data. Like if you do not have the live tracker data, you have no idea what's going on, right? And I could just see that shock. There was just such shock on all the home price data this week. And you're like, no, I said, guys, we provide this for you to read, right? So just kind of go with it. And we should not see acceleration of price growth. It should be cooling down, but it's current, right? This data line is old, and just remember, it won't catch up to us ever. We're always a little bit ahead.
Sounds amazing, Logan. Thank you so much for sitting with us today and giving our audience this insight. I would encourage our audience to read the tracker when it comes out on Saturdays. That's what Logan spends his Friday night doing so that you guys can have that on Saturday. Just looking at the data.
But tonight we are going to listen to some country music in Nashville. So
we are.
I'm very excited, and then I got to present tomorrow too. So
okay, wait, are you wearing your cowboy shirt? I mean, not.
I got my cowboy shirt on today. I got a cowboy hat somewhere. So
we'll take pictures, put them on social. But yes, we're going to the Grand Ole Opry. They are doing a special thing for us that is pretty exciting. So Logan, thanks for being on. We'll talk again soon.
Pleasure.